This is Accounting 230, Chapter 4 for the Zoom class. Hi, Anna.
Hi.
How you doing?
Good. I guess we're the only ones in.
So far, I expect a bigger crowd than this, though, no?
Yeah, me too. I didn't know if there was going to be one today.
Why wouldn't there be one today? Because of the holiday?
Or because the midterm is tomorrow or something.
Is your midterm tomorrow?
Yeah.
On chapters 1, 2, and 3, right?
Yeah, 1, 2, 3, 4.
We haven't even gone over 4 yet, have we?
Yeah, we did.
We did chapter 4?
Mm-hmm.
Well, maybe we'll just do some kind of review then today.
Yeah, that's what I thought.
Okay. Yeah, maybe that's why people are not coming in if they're figuring on the test, but we can have a little fun with the review. Okay.
All right.
All right. Well, let's get started then. You don't want to show your face, Anna?
I'm eating, if that's okay.
That's quite all right. It's quite all
All
right. That's quite all right.
Whoa.
There she is. Hi, Anna. How you doing?
Good. How are you?
All right. All right. Let's see what we have here.
Okay. Let me get my notes really quick.
Okay, I lost the PowerPoint for a second. Hold on. We went over chapter 4. It doesn't look like I recorded that, though.
Oh, interesting. Yeah, I have the notes and stuff, so.
Okay, the test is on chapters 1, 2, and 3, huh?
Oh, okay, cool.
I don't see the test in the modules. Did Cornelia announce that to you, that test?
Yeah, it says, hold on, let me see here. It says here, week 3, September 8th, which is tomorrow, is the midterm exam number 1.
Okay, chapters 1, 2, 3.
Chapters 1 through 4, it says.
1 through 4, okay. All right. Let's do this. Okay, here we go. Now we're going to get organized here. Let's go through the chapters. We'll go through the first couple of chapters a little bit more briefly because there's not too much meat there.
Okay.
Okay, let me share the screen if I can. Okay, can you see the PowerPoint, Anna?
Yeah, I can't.
You can, huh? Okay. What's for lunch or breakfast?
Eating a waffle and a veggie patty.
Ooh, that's good eating.
Yeah.
Okay. Okay, just let me move this out of the way. All right, and here we go. We're looking at the beginning here.
Okay.
Okay. You should be good on the 3 different types of businesses, right?
Mm-hmm.
And the difference in the characteristics of them.
Yes.
Who uses the information that are on financial statements? A lot of people, internal and external, right?
Yes.
I think we should be okay there.
Mm-hmm.
Then we talked about ethics.
Mm-hmm.
More ethics. I felt the pressure, peer pressure. So this chapter was really just an introductory type thing. Sarbanes-Oxley, right?
Mm-hmm.
Sarbanes-Oxley, that came out of the Enron and WorldCom scandals. Top management now must certify the accuracy of their information. There's penalties for fraud now. And the independence of the auditors was increased. Types of activities: financing, investing, operating. What's operating?
Operating is like, it's like the storefront, right? Like where they operate the business.
Operating is anything that's in the normal course of business.
Oh yeah, yeah.
The core business, like I'm always talking about. Apple makes iPhones.
Mhm.
Anything involved in producing an iPhone, selling it, paying their employees, buying things, selling things. Okay.
Wow.
What is investing? What are two examples of investing?
Isn't it like investing in like the property and
Yes, and equipment.
yeah, and equipment?
And what else? Investing in.
Stocks.
Yeah, exactly. Stock of another company, bonds of another company. And financing, what's a synonym for financing? What's another word for financing? Begins with a B.
Business.
Give me an O, B-O. Give me an R. Give me another R.
I don't know.
Borrow. I'm teasing you. Borrowing.
Oh, okay. Oh, yeah, okay.
Financing is borrowing money or raising money with stock. Okay?
Okay.
Let's see what else we have here. Yeah, we'll go through the first two fairly quick. Now they're just talking about a little bit about details. Know what's an asset, what's a liability.
Yes, I have
Yes.
like a whole list.
Okay. All right. What are our four financial statements? The income statement, retained earnings. They have to, the three we're going to concentrate on are the income statement, retained earnings statement, and balance sheet. They must be done in a certain order. What's the order that they can be done? They can only be done in one order.
Isn't it? Is it
And
balance sheet?
No. You have to do the income statement first, Anna.
Okay, and then the retained earnings balance.
And then retained earnings, then the balance sheet. You
And
do
then-
the income statement first because you want to take that net income and move it over to the retained earnings statement. And then when you get the final equity balance on the retained earnings statement, you bring that over to the balance sheet. Okay. Hi, Laura. Welcome back. Here we go. So here's an income statement. That looks pretty easy, huh? An income statement. It's sales minus expenses. Sales minus expenses. And take a look at your retained earnings statement. What was our net income? We see that, everybody? 2860, right? 2860. We go to the retained earnings statement. You notice we put it right in there, Anna?
Oh, okay. Yeah.
That's why you do the income statement first, because you're going to have to move it over here and add it to the beginning balance. Subtracting any dividends. Now we have the ending retained earnings. Now we can do the balance sheet. Now we can do the balance sheet. And here we go. There's the balance sheet. You just copy all these numbers from the trial balance, except for your new retained earnings number, 2360. Assets equal liabilities plus equity. Always in balance. Always in balance. Remember, we have three different types of cash flows, and we just talked about them a little bit. Operating, which is where you want to see your cash flows, positive. Operating, financing, which is borrowing, and investing, which is buying property or stock. Balance sheet, remember, is at a specific point in time. So your header on that has to say as of or at a particular date. You can't say for the month ended. Here's another income statement. Income statement, 6,800. We did that first, right, Anna? And here we go. We move it over here to the retained earnings, subtract dividends, and now we have the ending 6,200.
Mm,
Your balance sheet, okay?
yeah.
Remember that the financial statements will also have notes to them, and the notes are very important. And the annual report, U.S. companies that are publicly traded must provide shareholders with an annual report. That annual report has the statements, and then it has discussions, notes, auditor's report, all kinds of stuff. The annual report. Okay, I think we're good here. The kind of opinion you want from an auditor is an unqualified opinion. Everything is okay. Okay, then we're not going to do anything with the international, at least not in my class. Okay, so let me go back into the modules and we'll get into chapter 2, 3, and 4. Chapter 2. Come on, come on, come on, come on. Share screen. Chapter 2, we don't want chapter 2. It only wants to give me chapter 2, huh? I'll fix that. Okay. Yeah, that's what we want, chapter 2, right?
Mm-hmm.
Come on, share. Bear with me. Just give me a little bit of grief. Grief. Okay. That looks good. New share. Okay, chapter 2. Let's see what we have here. Again, this is a lot of introductory things. Okay, here we got involved with some of the ratios, remember? The classified balance sheet. What do we mean by a current asset and a current liability?
Like what you have currently.
It means that a current asset is an asset we're going to be using within a year.
Oh yeah, like mhm.
Current liabilities, we're going to pay it within a year, okay? Current assets, current liabilities. Then you have your long-term assets. That's your property, plant, and equipment. Intangible assets, goodwill, patents, copyrights. You can't see them, but they're there. And they have a lot in company like Walt Disney. I'm not so worried about the sections of the balance sheet. I think you kind of know that the classified balance sheet, you get a subtotal for different things. Subtotal for current, subtotal for long-term, subtotal for property, plant, and equipment, and intangible. That's what I mean by classified balance sheet. There's going to be a couple of subtotals. Beyond that, you don't have to worry too much about it. Property, plant, and equipment. Okay. Again, they're just presenting those subtotals. A lot of this is repetitive here. Repetitive. Stockholders' equity. Okay. Yeah, know what goes on. Know what goes on in each financial statement. Whenever you see what goes on the balance sheet, assets equal liabilities plus equity, right, Anna?
Yeah.
That's your balance sheet. Your income statement, the income statement is simply revenues and expenses, nothing more. Okay? So don't be putting cash on an income statement. Students love to do that.
I do too.
No, it's a balance sheet. And these two slides, slides number 30, 29 and 30 are worth looking at, okay?
Oh, okay. Let me write that.
And now we get the ratios. They're going to measure profitability, liquidity, solvency. There's two income statements back to back. Earnings per share. You remember this one now?
Yeah, I do. I
Okay,
remember.
this might be on the test. You know, net income minus any money that's promised to the preferred shareholders divided by the average outstanding shares. Okay, so you sound pretty good with that. Okay.
Yeah.
And here's an example of the calculation.
Oh,
Net
yes.
income is 26,000. Net sales are 400. We don't care about that. They're giving you the average shares of 6,000 and the preferred dividends. 26 minus 2 is 24 divided by 6. So that's not too bad. What's working capital? Current assets minus current liabilities. Current assets minus current liabilities is your working capital. Current assets divided by current liabilities equals what's called the current ratio. The current ratio. In this case here in 2017, the current ratio was 1.48 to 1. That means that this company, for every dollar of debt they pay down, they'll have 48 cents left over. So this company is in pretty good shape in terms of being able to pay their short-term debt. They could do it if they want. Solvency, the ability to pay interest as it comes due. Here's an easy one. Debt to asset ratio. You take your total liabilities, divide them by the total assets, and that'll give you a percentage. And in this case, it's 68% 1 year. It's 66, 68, 69. They're all around in the 60s. It means that this company in 2017 borrowed 66 cents for every dollar of assets they have on hand. So they're highly leveraged, okay? And they're giving you some examples of different businesses. Looks like the auto industry, they borrow tons of money to finance their assets. Well, General Motors is huge, and they're moving all kinds of raw materials all over the place. You could see where they would need to be financing all the time.
Yeah.
What's that?
I said, yeah.
Okay, we know what operating activities are. We just talked about that. Operations. Free cash flow is another one. Maybe everyone in the class who might be listening in later, look at this metric. Operating cash flow, less spending on property, plant, equipment, and dividends. What we're saying here is we have net cash provided by operating. Well, that's money that we can spend pretty much however we want, okay? That's the beauty of making a profit. But we do say to ourselves, we do want to spend money on property, plant, and equipment. So we're going to set aside 15,000 for that. And we do want to pay 5,000 dividends. So what's left is truly the free cash flow. You sure? Earnings per share. Then they give us a couple examples doing earnings per share. Free cash flow. GAAP, we know that term, right? Generally accepted accounting principles set by FASB, Financial Accounting Standards Board. They're the ones who make up the rules of GAAP. Generally accepting principles, set of standards recognized as the general guide for financial reporting. FSB. And you might look at this screen here just to go over some of the terms, comparability, understand. Some of this is quite self-explanatory. Might be worth a point or two in terms of a multiple choice question or true, false. These are different GAAP terms. Monetary unit assumption means that we can measure it in money, right? Economic entity assumption means that a business can be separately identified and accounted for. Periodicity, I help but laugh every time I say that. With periodicity means that a business can be divided up into a month for review. Going concern, we assume the business is a permanent, eternal thing. Historical cost, everything on your balance sheet is at historical cost. Full values, full disclosure. Anyway, those terms are worth going over.
Okay.
I have not seen the test, by the way.
Oh, really? I like the practice one.
Yeah. How was the practice one? Tough?
It wasn't hard. It was fine.
Okay, then you should be pretty good here.
Yeah, I think it was okay. I hope it's
And
like.
here's a good review here of the terms.
Oh, okay. Cool.
Terms. And we're not going to worry about IFRS. At least I'm not, okay? So that's a brief review of chapter 2. So let's concentrate on chapter 3. Chapter 3. Are you from around here, Anna?
I lived in Santa Barbara for like 2 years, like last year. And then last year I moved back down to stay with my mom.
Where's that?
In LA.
All right.
Mm-hmm.
I worked in downtown LA most of my working world.
Oh, really? That sucks.
Little Tokyo area, you know where that is?
I go there all the time.
We'll take a walk over to 2nd and Rose Street. You know where Alameda Street is?
No.
Yeah, Alameda is the big north. If you know where Union Station is, that's on Alameda Street.
Oh, really? Okay.
Alameda, go down Alameda to 2nd Street, then just look to the left and there's a building there. That's where I worked for many years.
Oh, cool. Was it like an accounting firm or something?
No, it was a big factory. Now it's an apartment building or condominiums. They knocked the whole place down.
Oh, that sucks.
Yeah, it was pretty cool. Okay, chapter 3. Let's go through chapter 3 because here we're really getting into some good stuff, okay? So here we talk about transaction is anything that's going to affect the business money-wise, huh?
Okay.
Anything that changes an asset, liability, or equity. And then certain things are not recorded in the financial statements. Discuss the trip with somebody, that's not a business transaction. Announce a hiring, that don't cut no ice. All right, analyzing transactions. Counting equation, always in balance. Assets equal liabilities plus equity. And notice stockholders' equity, Laura. Stockholders' equity consists of common stock plus retained earnings. Those are the two elements of stockholders' equity. And retained earnings is where you move the profit, the revenues minus expenses and the dividends at month end. And you're going to learn in a future chapter that we close out the income statement into equity. Okay. So okay, I don't want to go too far ahead. So here they're just talking about some transaction. We invested cash in a business. So that means that cash went up, right? And so did common stock. Now, Anna, do you have any question on these transactions as we bring them up? Purchased equipment by paying $5,000 cash.
Okay.
And here it is here. We spent $5,000 for equipment, and there we added the equipment.
Mm.
We received cash in advance. Now that's what's called unearned revenue. Money you receive in advance for work you're going to do later. That's actually a liability. You're going to debit cash, not debit, you're going to increase cash and increase that liability called unearned revenue. You owe $1,200 to this customer. You don't owe them dollars, you owe them the service, whether it's playing baseball or a concert or some other service. Maybe you're a lawyer, you got money in advance. Oh, let me go back. Sierra received Sierra received $10,000 in cash for work they already did. 10,000 cash goes up. Notice retained earnings goes up under revenue.
Oh, okay. Because
Okay. Yep. The components of retained earnings are the revenue, the expense, and the dividends. They bought an insurance policy. Well, when they bought an insurance policy, let me go back. When I'm always screwing this up, they paid the rent, $900. There we go, paid the rent. So no questions on that, I wouldn't think, right? Cash goes down. Notice the expense goes up.
Yeah.
They bought an insurance policy. Whenever you buy an insurance policy, by definition, it's an asset called a prepaid insurance. It becomes an expense later when you get the benefit of having the insurance policy.
Oh, okay.
They hired 4 new employees. They hired 4 new employees. What do you think? Do we have a journal entry to do there?
Yeah, so it's.
We do? Oh, I'm
They
sorry. Let me go back.
hired? No.
Hold on.
Journal entry.
Okay, they bought supplies. They hired 4 new employees. Does that mean we have to do anything in accounting?
No, because they aren't paid yet.
Right, exactly. Paid a $500 dividend. Notice that the dividends go up, meaning that equity goes down because dividends decrease equity, okay? And we paid them in cash. They're just kind of summarizing a few things. Now we get into debits and credits. Are you good with the debits and credits, Anna?
Yeah, I'm pretty good.
Are you really? Good for you. Accounts payable go up with a debit or a credit.
Accounts payable goes up with the debit.
You are wrong. You're just guessing. So you got to know your debits and credits. All right.
I'll review it.
And remember, every transaction has to have 1 debit and 1 credit, right?
Yeah. And
you can have 1 debit and 100 credits. You can have 1 credit and 100 debits. Got to have 1 of each.
Mm-hmm.
So here we're just putting some of those transactions in. Remember, this guy started a business.
Oh,
this looks like the cash account. Okay. He put in 10,000, spent 3, brought in another 8. The balance is 15. Balance is 15. If debits are greater than credits, it has a credit balance. I think we know that.
Mhm.
Okay. And now it just gets into different ways to try to memorize. And I myself don't find those particularly useful. Okay, this might be one of the screens you could study. Okay.
Okay.
Assets have a debit balance. Assets have a normal debit balance. What does the normal balance mean? It means the side, left or right, that increases the amount, okay?
Whichever is higher is the normal balance.
Whichever increases, yes, whichever increases the number, yeah. So assets have a normal debit balance. Therefore, liabilities, they would go up with a credit. You see that?
Oh, okay.
This is the hard part to kind of get under our skull. Okay? And revenues go up with a credit. Expenses go up with a debit. Do you like acronyms, those silly tricks to memorize something, Anna?
Yeah, I do.
Okay. Why don't you draw a T account?
Okay.
You drew a T account?
Yeah, I did.
On the left side, write these words down. After eating dinner.
On the left side?
On the left side, right vertically, one below each other. After eating dinner.
Okay. After eating. Okay.
The A stands for assets. Eating is expense. Dinner is dividend. And then on top of the left side of that, put a plus. Above the debit side, put a plus. Now on the credit side, put this down. You ready?
Wait, give me 1 second.
Mm-hmm.
Okay.
On the credit side, right, let's read comics. And on top of the credit side, put another plus. Both sides are the pluses, okay?
All right.
So let's read comics. That'd be liabilities, revenue, and capital or equity, capital. So you just have to memorize those 6 rules.
I like that. That's pretty
Well,
cool.
I hope it helps you. I hope it helps a few others.
Mhm.
Getting a good handle on the debits and credits can be pretty tricky. Can be pretty tricky. It seems easy, right? You only have 5 to worry about, really.
Yeah, it doesn't seem like hard.
But it is.
Yeah, it is. It's really hard.
Accounts receivable, normal balance, debit or credit.
Accounts receivable is credit.
Oh boy, you got a long way to go. Okay, you can do it. If you don't like that screen, this is a good screen here. So you can study this one, showing you which goes up. What goes up with a debit? Assets and expenses. Assets and expenses. The others go up with a credit, okay?
Okay.
So there's only so many ways I can, talk to you about that. Here's another screen. Maybe this one helps you click a little more. So they have these different helpers that are very good.
Okay.
So here's a good question here. Debits. The correct answer is increase assets, right?
Mm-hmm.
Assets have a normal debit balance, but a debit decreases liabilities because liabilities have a credit balance normally.
Yes.
Accounts that normally have debit balances are assets, dividends, expenses. Now we're going to learn to write a journal entry. Remember this?
Yeah, I don't like it.
Tough luck. Sierra issued common stock for cash. They borrowed money. So let's see what we're talking about here. Take a look at your journal entry. This is called a journal entry called the general journal. Okay.
Okay.
You debit cash. You debit cash, right? 10,000 to increase it, and you credit common stock to increase it. They both are increases.
Is it just for cash and common stock?
Yep, you're affecting those two accounts with this transaction.
Oh, okay.
Common stock is part of capital. Cash is debited, common stock credited. Notice the indentation on the common stock here, Anna?
Yeah.
Very important. We talked about that. Very important. You must indent.
The indent is the credit.
Yes, you indent the credits. Otherwise, you're going to be a rude person. Take a look at the next journal entry.
Okay, equipment is debit, cash is credit.
Mm-hmm. Yeah, so one asset went up and one asset went down, right?
Yeah. Mm-hmm.
Then we had another one. Here they're just showing you three of them. The third one, they're showing you here cash. Here it looks like we paid down a note. We owed people money. So
Ooh.
cash, we borrowed money rather. So sorry, we borrowed money. Cash went up with a debit. Payables went up with a credit.
Because you owe them money.
Right. So the liability increased. And this is the one we just did, where we exchanged cash for equipment.
Okay. That makes sense.
Okay, so they're giving us a couple of problems to work on here. They issued stock. So let's see here. They issued stock and they bought equipment. Take a look at the journal entry. We debited cash and we credited common stock. We issued stock to the public, okay? Have any questions on the journal entries, how they're set up?
3.
What's that?
Oh wait, what did you say?
I said, you're okay with the setup of the journal entries,
Oh.
what they
Yeah.
look like?
Mm-hmm.
Okay. Now, when you write a journal entry, that doesn't do anything at all. All you're doing is putting it in a file. When you go into your computer system and you hit the button post, then you're updating the general ledger. You're updating those T accounts. That's when the numbers get in there.
Okay.
So we're now going to post to the ledger. Now, remember, the general ledger is the books of the company. It's where the folders reside. The chart of accounts, you have cash, supplies, land, equipment. In this example here, think of each of those as a folder in your chart of accounts. Each one of them is a T account. And we're going to keep track of things in the general ledger, which is the T account. And there's your chart of accounts. Okay. Now, you understand what happened here? We posted this journal entry. Remember about 10 slides ago, we wrote this journal entry.
Yeah.
We debited cash and we created comments. Then maybe at the end of the day, we posted it. We hit the post button and look what it did. It moved that $10,000 into here and into here. Make some sense?
Oh, okay. Yeah.
That's what posting is. Now we have updated the general ledger. Just writing the journal entry doesn't do anything. It's the important step of posting that we need to follow up with. Posting. What does posting do? Transfers journal entries to the ledger. Transfers journal entries to the ledger. And then they're going back to the first chapter here, really. Determine, look at when you're doing the recording, determine what account is involved. Did it go up or down? And if it went up, do you need a debit or a credit? And here, they're going to just go through repetitive looks at the different accounts. Early in the chapter, before you ever heard of debits and credits, we were doing them horizontally across the page, right? We had that grid set up. Remember those 10? So here, cash went up, common stock went up. Now here, instead of doing this for the rest of the course, the rest of your life, you're going to do it like this in a journal entry, okay?
Okay, so much easier.
Yes, and clearer, yes. And then when we hit post, these numbers are repeated down in here, okay?
Okay.
So I think they just go through a couple. You did that one. We did. Let's see if there's another one. Let's take a peek at this one. We received an advance from a customer. They paid us in advance. We debit cash and credit the liability account called unearned revenue. When you are paid in advance, it generates a liability, a payable. Even though we just got cash, we owe this person a service or a product of some kind, okay?
Okay.
And then they're just taking us through the different ones, service revenue. But you get the idea. We prepare the journal entry and post to the ledger. That's what we're trying to get across. And I don't think we need to go every single entry. We already went over these entries. You realize we went over these entries just now.
Yeah. Yeah.
Horizontally, the old-fashioned way.
Mm-hmm. We did.
Yeah, they purchase supplies. Supplies is an asset, goes up with a debit. Accounts payable is a liability, goes up with a credit. Yeah, I don't think this test is going to be too tough. I really don't.
Yeah, I don't think so either. I hope not.
We don't want to blow you out of the water because this course gets a lot harder as we go along.
Oh, I know. I'm scared.
Plus, I'm using a new, as you know, we're using a new publisher. I'm used to teaching the other guy.
The Wiley thing.
We're doing Wiley. I'm a McGraw-Hill guy from my experience. And
Oh.
here they're just, what's that?
I said, oh, I know McGraw-Hill.
So they're just listing all the journal entries we did.
Okay.
Yeah, think of it this way. All right, Anna, I want you to write all those journal entries. And so you go out and you're working for me and you write all the journal entries. Anna, have you finished the journal entries? Yeah, Bob, they're done. I said, let me take a look at them. I look them over, you look them over, and I say, are they correct? And you say, yes. Now you post them. You post all 7, 8 transactions at one time. And there is your general ledger. How about that?
Oh, okay.
Yeah, look what happened. We had that 10th. You probably recognize a lot of these numbers from the problem, huh? The $2,500 in supplies, the $600 in insurance. So there's your general ledger. At that point, we're ready to do our financial statements. It's the end of the month. Posting, you've heard me say that word about 100 times, right? Posting, selected transactions from the journal are presented. Post these guys, post them. They're not posted yet. I guess what they wanted you to do is have a hard copy and write the numbers in here. But how would you post it? You would take the 30,000 debit and put it right here, right?
Mm-hmm.
You would take the common stock and put it there.
Yeah.
Just like you see up here. There it is there. Common stock, 10,000 common stock.
Okay.
Now we're going to prepare a trial balance. And we've talked about a trial balance, I believe. A trial balance at the end of the month. This here is nothing more than a listing of all the accounts And the balances, whether they're debits or credits. It's a worksheet. It's not a report that's going to go out and should be shown to anybody. It's only used by the accounting people, okay?
Okay.
So now we're going through this whole cycle. We're going to end the cycle right here with the trial balance. It's a list of the accounts and their balances. It's in the order, Anna, of assets, liabilities, equity, and revenues and expenses. That's important, okay? It goes in the proper order. Let's finally take a look at one. Take a look at this. Here is a trial balance for this company. I see cash 15,200, right?
Yeah.
I see supplies 2,500. Where did we get all those numbers?
They're from the ledger.
Exactly. They came right out of here.
Yeah.
Right? Good. So there's our trial balance. You might get in the habit of doing this. I like to put a horizontal line right above my first revenue account. Just imagine putting a horizontal line there. Everything below that line is your income statement. Everything above is the balance sheet. That's why I suggest that. Okay.
Okay, sounds good.
And the balance sheet, just because the debits equal credits doesn't mean the balance sheet is correct. In fact, we know it's wrong, but we're not going to worry about it in this chapter. We know there's a few things to adjust. So here they're asking us to prepare a trial balance in good order. Just take a look at this real quick. We're not going to do the whole thing, but we said that the trial balance goes in order of assets, liabilities, equity, and revenues and expenses. And then the assets and liabilities go in order of liquidity. Which do you think would be the very first line of the trial balance from these accounts?
The cash.
Cash, and then probably what would come next?
And then probably the common stock.
No, that's not an asset. You got to pick up your assets. What are the assets? I see accounts receivable.
Oh, accounts payable too.
Nope, that's liabilities. Let me show you.
Equipment. It would be equipment.
Equipment and also the prepaid insurance. That's an asset.
Oh, yeah.
And then liabilities, those are easy because they usually say payables, right?
Yeah, so accounts payable.
Salaries payable.
Notes payable.
Notes payable. There you go. So let's see how this looks. See?
Oh, yeah.
Cash. Now you were saying common stock. That goes in the stock section. All right. Okay. So this is probably a good little problem just to look at. Help you get a little more familiar.
Mm-hmm.
And that's it, because I'm not going into IFRS, okay, which is the international bunch of rules, okay? Well, hopefully that helped a little bit, Anna, to get you ready for tomorrow's test.
It did. Thank you so much. I was a little lost. So,
you have any questions on anything?
No, but I think Laura has a question. Laura,
let's see what Laura has to say. Oh, she's asking about.
Yeah, is there homework this week or is it just the midterm? Because I didn't see any.
If there's nothing there, there's nothing there.
Okay, so
Laura, you're asking about when will the next module be? I'm going out of town. I'll talk to Cornelia. I mean, it should be up there now. I mean,
I don't see it. That's so weird. And is chapter
okay
Saturday? Oh yeah.
Okay, I'll make sure. It looks like she's releasing the modules like 1 or 2 at a time, huh?
Yeah, she is.
So you did chapter 4, okay, huh?
Yeah, chapter 4 is fine.
Okay, yeah, let's just worry about the test and we'll get that up there for you, Laura, so you'll be able to do it wherever you are, okay?
Awesome. All right. Thank you so much, Professor.
Okay. Yeah, you'll have plenty of time, Laura, to get it done for Saturday. Okay, well, we'll see you later. Tell your friends, everybody, stop in next time, okay?
Okay, will
All right.
do.
Okay, bye-bye, everybody.
Wait, is there gonna be a lecture thing on Thursday as well?
Yeah,
Okay,
we're
cool.
twice a week, right?
Yeah, right. I wasn't sure.
No, we're gonna give you a whole week off to recover from the test. Of course, there's a lecture on Thursday.
I'm like, I hope there is a week off. All right. Thank
All right, we'll
you.
see you then. You guys take care.